Hey everyone, this is Mastering the Basics, the foundational course here at the Income Option, where we will discover the exciting world of options trading and look to master the key concepts and strategies that create profitable market participation. In this first video of Track 1, we're going to explore the concept of an options contract. This is foundational knowledge. It is crucial to what we do here at the Income Option. Without a solid understanding of what an options contract is, who the parties involved are, and the fundamental principles behind it, progressing to the next level can be quite challenging. That's why this is the first video here in our Track 1. Now, to avoid confusing you with industry jargon and terminology, I want to emphasize that an options contract is simply an agreement between two parties for the sale or purchase of an underlying asset. What is that underlying asset? We'll look at it in a minute. While most people use options contracts for buying and selling stocks, which is also our focus here, options contracts are not exclusive to the stock market. They are used across various markets and various situations, business deals, real estate transactions, and many other types of transactions. However, in our discussions, we will primarily focus on their use within the stock market. Now, here's the deal with options contracts. As I mentioned earlier, an options contract is simply an agreement between two parties. In our case, we're discussing a stock certificate on which this contract is based. We have a buyer on one side and a seller on the other side. Now, for the purpose of this example, we're going to assume the stock is currently valued at 100 rupees. So, in a typical stock transaction, if the seller owns a stock and its value is 100, then the buyer simply transfers that money to him. He can purchase that stock for 100 rupees by transferring that amount to the seller, and the ownership of the stock shifts to the buyer. Simple and straightforward. But in options trading, in options contracts, several different scenarios can unfold around this 100 rupee stock. Let's take a very simple example to illustrate this point. The option buyer communicates with the option seller, stating their intention to buy the stock if its value increases. They want to buy it at a predetermined price in the future, let's say 500 rupees. Now, this sets the foundation of the options contract. It's built on this assumption, the assumption by one party or another about the future value of the underlying stock. The buyer could buy the stock now for 100, but they instead wish to establish an options contract with the seller. This agreement stipulates that at some point in the future, they will want to buy the stock at 500 rupees. Now, at first glance, this might seem a little odd. Why buy the stock for 500 when it's currently available at 100 rupees? Here's why. What if, in the future, the stock is worth not 100, not 500, but 1000 rupees? Suppose the company lands a large contract, discovers something new, or makes an invention of some sort or the other, which causes the stock price to rise from 100 to 1000 rupees. Now, the option buyer, if he had a contract in place to buy the stock at 500, will be able to get that stock at 500, which is significantly less than its market value. Now, to structure this contract, the option buyer needs to set a timeline and pay a premium to the option seller. For example, let's assume that the agreement is valid for 1 year from today's date. During this year, the option buyer has the right, but not the obligation, to purchase the stock for 500 rupees per share. After 1 year, the option buyer no longer has this right, as the contract with the seller would have expired. Now, the expiration date in most options markets can vary anything from 1 week, like in the Nifty, to several years out in the future. Now, let's consider the seller's perspective. The seller is agreeing to a future selling price of 500 rupees, as we saw in the earlier example, potentially missing out on this higher profit, if the stock price rises beyond that, of course. Therefore, they need an incentive to enter the contract. So he says, where's the incentive? This is where the premium comes in. Let's say that to secure this agreement, the option buyer pays the option seller a premium of 40 rupees. So here's the incentive, this premium of 40 rupees. This payment compensates the seller for the risk they are undertaking, and if the buyer never exercises their option to buy within that year, the seller keeps the entire premium. Now, this process might seem a bit complex at first, but it becomes more logical as you understand the motivations of each of these parties. So, what is the motivation? The option buyer is willing to pay a small premium now, 40 rupees, to potentially control the stock if it goes above 500 per share. The option seller, on the other hand, hopes that the stock will rise, but not above 500 rupees. If that happens, if the stock price does not go beyond 500, he gets to keep the premium as well as the shares. Remember, this is a simplified example. In reality, there are countless ways this can play out. The contract's strike price could be set at 400, and the buyer might only exercise their option if the stock price exceeds this level. The contract duration could also be adjusted. Perhaps it's valid only for 6 months instead of a year. This is likely to reduce the premium paid by the buyer. Hopefully, this helps you understand the basics of an options contract. It is simply an agreement to buy or sell a stock at a specified price in the future. We'll understand the rights and responsibilities involved in these contracts later on in this course. But before that, I want to get into certain concepts that are absolutely necessary to understand at this level. The first one is the strike price. The strike price is the agreed future value of a stock in an options contract. In our example, the stock is currently valued at 100 rupees and the strike price is set at 500 rupees. So this is the strike price. This is essentially the price at which the parties have agreed to trade the stock in the future. Next, we have premium compensation. This is the amount that is transferred from the buyer to the seller to initiate the options contract. So in the example, since the buyer always pays the premium always comes from here and the seller always receives the premium. The reason for this is that the buyer is obtaining a right. The right to buy this share at a future date is transferred from the seller to the buyer, while the seller is undertaking the obligation. So the obligation moves to him. Hence, he needs to be compensated. In this situation, the buyer is paying him 40 rupees for taking on that obligation. The time consideration is another crucial aspect of an options contract. All options contracts have an expiration date, a point at which the agreement between the two parties ceases to exist. So the expiration can vary from a week to several years. We see that every day in the Nifty, the Bank Nifty, other options which have weekly expiries, and then the stock options which have a monthly expiry. Generally, the longer the time component of the contract, the more valuable it becomes, as there's more time for the security to move into the favorable zone, to move above or below the strike price that has been selected. Now let's discuss exercise and assignment. In this example, if the strike price is 500 per share and in the future the stock's value goes above 500 rupees, let's say it becomes 1000 rupees, then the buyer can submit a request to the seller for the stock. This is known as exercise. So he is submitting a request to the seller to transfer the amount of the stock to them. They can then resell the stock for 1000 rupees, profiting from the difference. This exercise request prompts the seller to transfer the stock to the buyer at the agreed strike price. This is known as an assignment. So when the buyer sends the request for the transfer, that is known as exercise. When the seller transfers, the stock is known as assignment. And finally, rights versus obligation. An option seller essentially gives up the right to the stock for anything above 500 rupees. If the stock is worth less than 500, the buyer won't exercise their agreement, as they could purchase the stock in the open market for less. The right to buy or not lies with the option buyer who paid for that choice. So the right is sitting over here. The seller, on the other hand, since he has accepted the contract and received the premium from the buyer, is obligated to sell the stock at a predetermined price in the future if the buyer wishes to buy. So the obligation stays with the seller or is created with the seller. In conclusion, an options contract is an agreement between two parties for the sale or purchase of an asset, the underlying asset. So understanding these concepts can help develop a strategy around options trading, providing us with more flexibilities and opportunities than simply buying the stock in the open market.